So this is my price target for Home Depot. This is what I think the stock should be selling for. It's based on two different valuation methodologies. It's based on the free cash flow or the discounted cash flow, and it's based on the EV to EBITDA valuation. I'm going to weight this. And so what is my target price for Home Depot? Keep watching to find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. Okay, wasting no time, we're getting into this. I know some of you might be dividend investors. Some of you might be interested in just dividends, understanding what this company does with dividends. That's where we're going to start today. So here we have dividend metrics, 14-year increase in dividends. So pretty good. It's not bad. We have a dividend yield of 2.72%. Not too bad dividend yield. It's all right. Dividend growth has been about 17% over the past 3 years. Now the payout ratio based on its free cash flow. So I'm not actually using this based on earnings, which a lot of people do. I'm doing this based on cash flow. So it's almost 50% of its cash flow is going to dividends, which I'm totally fine with. However, there's an issue here, and that is that the share buybacks, when you add in share buybacks and just how much money they're spending on share buybacks, it just jumps up to a very high percentage of their free cash flow, and it's not sustainable the way I see this. So what I think is that there's not going to be sustained both dividend and share buybacks. And so what I do is I adjust this when I'm trying to do a valuation. So I'm going to basically reduce how much I think they're going to be paying or buying shares back going forward, because I don't think it's sustainable to do both these things. I think they will probably continue paying a dividend because most companies don't cut dividends when they might cut share buybacks, but dividends kind of like I'd say the last thing to go between those two. All right, so let's talk about the EV to EBITDA valuation that I got here. So I have a selected target price for 2022 of $330 per share. 2026, I have a target price of $480. So basically, this is a 18% return if this were to occur, and this is a 11.49% return compounded annually until the year 2026. If you bought it, held it until then, you'd make an average return per year of this amount. Now, this, of course, is the EV to EBITDA valuation. We're going to go through a discounted cash flow, but let me show you what I did here to get this. So I went with 3 simple steps. So step 1 is the shares outstanding. I forecasted them. Now, like I said, I don't think share buybacks are going to continue as much because of what's going on with the dividend payments plus the share buybacks. There's just a lot of money being spent towards those two things, and I don't think it's sustainable. So I did take a bit of a decrease on what they're doing with shares outstanding. They were buying them back at about negative 2.77% median and negative 2.61% average. I did negative 1% per year, so they're spending less money in buybacks. EBITDA growth, so we have some median growth of 13.38 and 15.07 for the average over these different numbers I have here. So what I did was I said, let's say that this year is not going to be very good. Potential recession on the horizon right now, Home Depot. I just don't think that this company is probably in a great industry to be dealing with a recession, especially with what's going on also in the housing market. So potentially, let's say just a 1% growth rate, not much growth. Then we have it ramping up 5, 10, 10, 10. Remember, these are lower than both the average and the median, so I have it growing lower than it was in the past. Essentially, what I'm trying to do is be pretty balanced, be pretty conservative, especially where we are in this economy right now. And so I get step 3, I get my EV to EBITDA valuation. Now I need to put on a multiple on here for the EV to EBITDA. So what I do is I say, okay, it could be 15 was the average, 15 medium. So that's good. They're pretty close. I'm going to be conservative. I'm going with a 12 for my multiple over this time period. So 2022, we have $330 per share with a 12 multiple. If we have the same multiple by 2026, $480 per share. So of course, if you do think that Home Depot will have more of a closer multiple to its historic average and median over the past few years, then you could go with a 15. You're going to get a higher target price. But again, I'm going to be more conservative. I'm going to stick with a 12. So that's EV to EBITDA. Let's take a quick look at my Cat 5 score. So this is just a score I created. These are things that I like to see in companies, and so I created a score. based on those things, so we have first the industry-based valuation. This doesn't get a good score. It's got 0%. I'll go over in really quickly how I derive these. Industry-based profitability, 70%. Industry-based growth, 60%. Liquidity score, 100%. ROIC score, 70%. Total score, 47%. Essentially, I want all of these to be 70 or more percent, and I like to see the total score over 70%. So, not quite there yet. To kind of just show you how I get to these, so what I do is I take these different metrics I care about. So, for example, the industry-based valuation, I take a look at all the different PE ratios of companies in a similar industry. I say, what are the PE ratios? What is the PE ratio of this company? Is it in a decile that's attractive? And so this is in the 8th decile, meaning that it's more expensive, right? So there are a lot of companies that have cheaper PE ratios. So this doesn't necessarily tell me everything I need to know, but generally when I put all this together and I look at deciles, it kind of helps me take a look if I think, for example, this is a highly valuation-wise, this company is maybe not as good compared to its peers, which is what it kind of looks like here. Industry-based profitability here, it got a decent score. Industry-based growth, it got an okay score, 60%. Liquidity score, it's good. It has a decent debt-to-equity ratio. And then the ROIC score, which is where I look at the Piotrowski F score and the shares outstanding, if they're increasing or decreasing. And so that's that. Not exactly a great score for what I like to see. So, okay, last thing we're going to do is do a DCF, and then after that, we're going to find the weighted average of this stock. So in terms of discounted cash flow I have for Home Depot, I'm on GuruFocus.com here. I'm just using their DCF calculator. So take a look back and you see some of the different free cash flow rates of return. So they've grown at about, over the past 10 years, 16% per year free cash flow growth, which I'm happy with that. I like to see more than 10% per year growth, and higher is always better, of course. So 16% is great. Now, I don't necessarily think that this is going to continue over time. I'm going to reduce this growth rate a bit to be more conservative. So what I did was I said, all right, so let's go with we have 9% discount rate, and we're going with 10 years at a growth rate of 13. So 13% growth, a little bit less than that 16% longer term average. That's what I'm going to go with here, especially going into potential hard period of time for a company like this. So a little lower growth over the next 10 years, and it's going to give me about a $252 price target. So it's definitely less than the EV to EBITDA valuation I did before. So let's take a weighted average and see what we got. So here we go. This is my price target for Home Depot. So what I did was I said, okay, discounted cash flow, we're going to weight this higher because this is likely a little bit more important than EV to EBITDA multiple valuation type thing. So we're giving this 60% of the weighting. This is $252 weighted at 60%. And then the EV to EBITDA valuation, we're giving a 40% weighting. That's $330, so much higher target price there. This is going to give us a $283 target price. Essentially, I think Home Depot is pretty much fair valued right now where it sits. So for me, I would wait for this company to maybe potentially fall further. I don't know if it will, but if it did, I would just wait a bit. So let's take a quick look at technicals now and see what's going on there. Okay, so really quick what we're talking about with Home Depot, just a few things I want to just touch on. So basically we're looking at a chart here going back until July of 2021, so it's about a year old. We got pretty much, looks like a double top, potentially you could call it a triple top. Doesn't quite look like a head and shoulders formation, so it's called a double top. So the last part of that top was very started January, so this thing has fallen a lot since then. It's down around 33% since that high, so obviously if you had bought around then, you're really not too happy about buying the stock. But, you know, we've been in a pretty much decently looking downtrend channel. We can see that it's kind of closer to the lower part of the channel, which I do like. If I was to purchase a stock like this, I would like to maybe purchase it down towards this like lower part of the channel if I could. If I was purchasing a stock like this, what I do is I like to buy a stock that I like both fundamentally, so my price target, and then technically. So if I'm buying a stock like this, I want to see a price target that I like. Again, it's like $330 per share or $280 per share. And then I want it to be maybe in an area where I think there potentially is decent upside. So this could be at the bottom of a channel. It could be at a breakout, right? So things like that. I do like more to be in a bottom of a channel But anyway, so what I'm seeing here is I'm seeing some decent resistance, decent support areas going back where there's actually a pretty big gap back in the 24th of February of 2021. So I think this could be a decent support area for the stock, and this is at the 260 area. And so what I'm looking at here is I'm saying, okay, if this stock were to fall from here to 260, that's about a 5.2% loss. And then if it was to go up to where I think there's other potential resistance, so this thing could run up, let's say, to this uptrend, downtrend line where it kind of started, where this little gap is. And if it did get up there, that's a 22% gain. Of course, this is kind of detached from what I'm saying. I think that the stock price should be about $280 per share fundamentally. So anyway, that's all I have for this video. Hope you liked it. Let me know what you think about Home Depot in the comments below, and watch another one of my videos coming up on the end screen right now.